In the past week, we have seen a bloodbath in our equity markets, and not just in our equity markets. We're seeing bloodbath all over the place. It was actually led by China because of um, that devaluation on Tuesday, which effectively brought the Chinese currency cheaper by about around 3.5%. And they expect that depreciation to continue to about 7% for the rest of the year. As a result, you saw huge declines in all the developed markets, with the US in the last 4 days showing about a 1,600 point decline in the Dow Jones Industrial. That's close to 10% decline in the market capitalization of the Dow Jones, and I think even the S&P 500. Now, what does that reflect? People are looking at a global slowdown in growth on account of China. Is that something that is definitely coming? Well, for one thing, if we look at the figures, China's growth has actually been slowing for more than 5 years now. If people will recall, China had nearly double-digit growth in the first decade of the century, or going to the first decade of the century. But since 2010, growth has been slowing down to single digit. As a matter of fact, the forecast is that growth will continue to decline to lower single digits. So the fact that China, or the expectation that China will slow down, is actually already built in to whatever prices there are. Of course, there was a huge decline in the Chinese stock market over the last 3 months. But if we analyze what went on over there, it was actually foreign funds that were selling into that rally, meaning a lot of global investors are out of the China market and in holding cash, or holding it in non-China asset. So what does that mean going forward? Well, is the global economy going to slow down? I think that yes, there will be that possibility cannot be ignored. However, if we look at the growth trajectory of the US, Europe, and Japan, who combined make up a huge portion of global growth, US is growing above 2%, and that seems to be a sustained growth. That's why the US Fed is looking to raise interest rates already and bring things back to normal. In other words, the US is no longer in a zero growth or in a recessionary mode. The US is in a positive growth mode, which requires a bit of normalization of interest rates. Europe, Germany had grown at 0.8%. Greece, if I'm not mistaken, in spite of the crisis that we're seeing in Greece, grew about 0.3% in the last quarterly figures. Spain, Italy, and Portugal are also growing. So Europe, with Europe, the fear of a slowdown may be a little bit overblown. Japan definitely has been growing quite a bit on account of weaker Japanese yen. Of course, the yen has strengthened a little bit over the last few days, but still, it is 20%, at least 20% cheaper than it was more than 12 months ago. So, given that scenario, yes, there is a threat for global slowdown, but is it going to be as deep, for example, as the 2008-2009 recession? I believe not. The 2008-2009 recession was triggered in the United States, and everybody else followed. Why? Because the influence between the economies of the United States and Europe are quite close. China is a net provider of goods to practically all countries in the world. So with the continued devaluation of the yuan, what's going to happen, I think, is that you're going to have a greater availability of goods coming from China into the world. So what will the result? The result will be lower inflation worldwide. You know, if you recall in the 90s when China increased their productive capacity, it sparked a reduction in global, or a decline in global inflation, which we continue to feel today. Oil prices will remain low because of excess supply, a lot of supply coming from all over the world, as well as the presence of alternative energy. So with low oil prices, with low prices of commodities, with growth already in the cards in the developed countries, although not very strong growth yet, I personally feel that the threat of global recession on account of China might be a little bit overblown at this point in time. I think the reason why markets have declined was because when a major crisis arises, people want to move away from risk. So that's what they're doing now. So let's go to the Philippines. Our fundamentals continue to be strong. As I mentioned earlier, above 5% growth. Now let us not forget that we are going to be in an election year next year. And history has shown that in every election year, the country has grown above normal, way above normal, about 1.5% to 2% additional growth on account of election spending, infrastructure spending, etc. There is no question that it is going to happen again this year. Absolutely no doubt in my mind that we will have incremental growth on account of election. Our position with China is that we are a net importer. China absorbs about 10% of our gross exports, but that is, around $7 billion dollars a year maximum. So what is that compared to a $300 billion economy like the Philippines? That is, just around 2 or 2.5% of our total GDP that we export to China. But we have to remember that we are, like the rest of the world, in deficit with our trade with China, meaning we buy more from them than we sell to them. What does this imply? This means that we are able to enjoy more of their goods at lower prices, which is probably good for an economy like ours, which is 70% consumption driven. Okay? So, what's happening right now? No, we still have very positive fundamentals, strong international reserves, strong current account and balance of payments, low inflation, core economic growth remains steady above 5%, could be higher next year, could be as high as 7 to 8% on election years, as we had seen in the past. So, this decline in assets, financial market assets, in my opinion, is a temporary phenomenon. Just like it was a temporary phenomenon in the global financial crisis, just like it was a temporary phenomenon in the Asian financial crisis. We will recover, undoubtedly. Why? Because values are being created. To give you a perspective, the reports that have been disclosed over the last few weeks for first half company earnings, we have seen an earnings growth of about 7% compared to around the 5% growth in GDP, or 5.2 in the first quarter, maybe another 5.2 in the second quarter. That's not a very big growth, but earnings have been growing at 7%. So earnings of companies have been growing faster than the economy has been growing. And now the market has gone down. No? The market is already below its beginning of the year level, equity market, the stock index, I mean. So there is an opportunity here where the values of equities are probably lower than the price. And at some point in time, it will catch up. We think it will catch up, you know, in 3 to 6 months, but definitely are values being eroded, are asset values being eroded in our country as a result of the China devaluation? I believe that. I believe that. No, all you have to do is look at the airports all over the country. Filipinos are traveling. Filipinos have money in their pockets. No, you can look at our malls, our tourist spots. They're filled with Filipino tourists and Filipino shoppers. So, with money in the pockets of Filipinos, with more jobs being created, with cheap goods coming from China, with low oil prices, I believe the profitability of Filipino companies will be sustained this year. So, if we are to look at the current situation, I think we should look at this situation for the opportunities that arise. Remember, in Chinese characters, the character for crisis is a combination of caution and opportunity. So, in this perceived crisis or perceived financial crisis, domestically and globally, we have to be cautious, yes, but we also have to look to spot the opportunities. And I think that's what we would like to impart to you right now, that we are carefully spotting opportunities with caution, because we have to be prudent investment managers, but definitely there will be opportunities out there because fundamentals remain good. Thank you very much.